SoFi's had a ton of news this week, including a major product from Galileo, and yet the stock seems to keep falling every single day, 1 week out from Q3 earnings results. And in this video, I'm going to recap all the major pieces of SoFi news that I've seen. Let's jump into it. Okay, so point of order number one, the audio might not be as great. It's because I am recording on vacation. Interestingly enough, the stock finished around -8% as of this recording. And funny enough, the stock just started dropping when I started leaving for vacation. So that's what I get. Now, there's a couple of pieces of news that I've been following. 2 days ago, Chris at Data Driven Investing made a post called SoFi's Next Growth Vectors. I was tagged in this article, so I thought I would give some of my thoughts. The whole idea here is whether SoFi's growth rate is sustainable and whether it's realistic. Chris's core thesis around investing in SoFi has been a 30% compound annual growth rate for the next 10 years. And one of the headwinds here is that SoFi is becoming capital constrained, as we've discussed before with regards to the originations and having to sell loans. But with lending making up 2/3 of SoFi's revenue, net interest margin continues to expand. The student loan segment of their business is returning, and member growth is also driving personal loan originations, which basically leads Chris to conclude in his article that the 30% revenue growth in the lending segment seems quite manageable. From an analyst perspective, SoFi was upgraded to hold from sell by KBW. And earlier today, I saw a report on X that SoFi was initiated with a neutral rating at UBS. Haven't been able to confirm that one, but let's get into the main piece of news, which is Galileo Corporate Credit Solutions for expense management. So basically, Galileo introduced a central account with a single credit limit for a streamlined billing and repayments. This simplifies tracking and management for multiple employee charge cards. And in addition to that, it offers some real-time visibility into credit across all connected cards, enhancing the security and control over corporate level expenses. Now, expense management, traditionally, companies struggle with this as they have to track multiple employee charge cards and their individual limits per employee, often requiring repeated calculations to get the full story. And this offering, really what it does is it removes a lot of the accounting complexities and enables companies to focus on their business with a streamlined spend management option. So really the takeaway is that it's going to allow companies to gain better control of their expenses and make more informed financial decisions with real-time credit visibility. A couple of my thoughts, I went on Tanner's FinTech Frenzy and I shared some of my thoughts in real time live. I've had an opportunity to read a little bit more about this offering since that time, and I'm reinforcing this idea that this pain point is prevalent in large enterprise customers, and it seems very in line with SoFi chasing bigger enterprise deals as opposed to smaller opportunities, right? This helps make Galileo a one-stop shop for their clients' needs. And Galileo has been releasing something new every week, right? We had the SMB lending APIs, the buy now, pay later, basically for SMBs. We had fleet management, now we have expense management. Essentially, Galileo is moving to this point where they can do everything plug and play, and that makes the offering more compelling to large enterprise clients, which is in line with their strategy. And this is important as we head into Q3, as we're expecting the tech platform margins to rise, along with a number of accounts ramping on the technology aspect, right? So we know some large tech institutions are piloting Galileo, and this is an offering that could have even come as a request of these enterprise clients to have a full end-to-end suite covered by Galileo. But of course, I think we're going to get some more guidance on what management has to say about the tech platform going into the end of the year, into Q4, on the call in just about 10 days. Another piece of news that I saw was the AOS Tour film, which was filmed partially at SoFi Stadium. On October 13th, Taylor Swift released the self-produced concert film called Taylor Swift: The Eras Tour, and it became the highest grossing concert film of all time. At the domestic box office, it was the second biggest October debut of all time, trailing only 2019's Joker with 96 million. The Eras Tour movie box office did 92.8 million in North America and 123.5 million globally. And one of the most insane things that I saw here were the reviews. It has a 99% audience score with over 2,500 reviews. Now, I did also see this post, which Chris had reposted. The original posting says, I saw the Taylor Swift movie. It takes place in SoFi Stadium, which Taylor calls out, and the SoFi Stadium logo is regularly in the movie. Best product placement ever by being associated with the most loved woman in the world. And in her last song, she's wearing a SoFi blue outfit. Chris basically reposted this, saying the AOS Tour was filmed at SoFi Stadium, and there's going to be tons of free, repeatable advertising for SoFi from their biggest name in music in the entire world. This obviously plays a part in their brand awareness. One of the main critiques after I made videos around Taylor Swift's AOS Tour, the concert at SoFi Stadium, was that this concert was very short, only 6 days at the actual stadium. Well, now, similar to the Weeknd's album, which was, the recorded at SoFi Stadium album, this movie will feature SoFi's advertising permanently. And it's quite a significant achievement considering it's the highest grossing concert film of all time. And the most remarkable thing is that this movie wasn't even added to the calendar until 6 weeks ago. And yet it completely broke these records. So to have SoFi associated with that level of attention is really interesting as well. But I think, from a news perspective, one of the biggest things is really the macro here, right? This is the reason why a lot of these stocks are falling. It's driving many of these names lower. It doesn't help that CPI came in hotter than expected. And overall, I think the market is just grappling with the effects of what higher for longer means, what that environment looks like. I'm seeing increasing talk on X around the US debt spiraling. On top of that, there's additional uncertainty around escalations in terms of geopolitical conflict, which adds more fuel to that situation. I'm going to read a post here which talks about the interest rates in 2024, saying interest rate futures are now showing cuts beginning in July after retail sales data. This was posted just a few days ago. So if we just look at this chart here around the meeting probabilities, you can see organized on the left-hand side from November 2023 all the way to December of 2024. The highest probabilities are colored there, and it only starts to fall around June or July. You can see that it spikes up in May, and it increases still in June and July. Those are the most likely months that the futures are signaling rate cuts beginning over the next year. And I mentioned this on the SoFi Weekly podcast last week, saying that I believe the Fed might start cutting rates sooner as something is going to start to break in the economy at this rate. And I think I'll end this video with a post that was made today by Chris Patel on his take on the macro, saying, quote, here's a play-by-play of what I think is going to happen in 2024. Basically, right now in late 2023, everybody is going to talk about recession. We saw Elon talking about this quite heavily in the Tesla earnings call. Companies will cut capital expenditures and employees for 2024 because of a recession and high capital costs, which will essentially speak a recession into existence. If you have more rounds of layoffs, we saw a lot of layoffs coming in 2022 and the expectation of a prolonged trough and towards the end of 2022 and in the beginning of 2023. Chris is basically saying that we're going to have more instances of people losing jobs. And as they lose jobs, they're going to lose their pricing power, which is going to be deflationary. And this is obviously going to affect the housing market because the home values fall. The Fed is then going to be forced by politicians to start cutting rates. I also think this is one of the reasons why I expect rates to be cut sooner, because we are heading into an election year in 2024. People will panic and buy long duration treasuries in anticipation of rate cuts. As the Fed cuts rates, the price of homes keeps going down more and more inventory makes its way onto the market. This pushes deflation further. People see this and other countries start buying treasuries, thus further putting pressure on yields. And finally, this pushes the cost of capital down for a lot of highly levered companies. And with every incremental rate cut, those assets get bid up. So I think that's a good play-by-play, and I wanted to end the video on that, as this week has been pretty macro-driven. Obviously, the news from Galileo is good. Obviously, we're heading into Q3 earnings, and there's a lot of expectations around that for SoFi to be beating. Next week, I should be back to normal and making videos around expectations I have heading into the Q3 earnings. For right now, this is the Fundamentals of Investing podcast. Thank you so much for listening.